Ahoy there, trader, and welcome back. This is the Anti-Investor Stock Market and Income Trading Podcast. Trading is hard, but let's make it easy. I'm going to be breaking down how to solve some of the stock market's hardest challenges. So today, let's talk about starting small in trading, which is one of the biggest secrets to my long-term success. So welcome to the Anti-Investor Stocks and Options Trading Podcast, where we talk about what really works and consistently wins at trading the financial markets. My goal is to give you the right tools, the correct rules, the software to assist you, a community to support you, and if you will allow me to be a mentor to show you the right way so that you get real results in the fastest and smartest possible way. So for many new traders, the principle of starting small is essential. Adhering to the philosophy of being in business tomorrow by not betting the farm, trying to win big today is paramount. Now, this approach is crucial to gaining experience while also preserving capital. Again, you want to be in business today, tomorrow, the day after, week after, the month after, a year down the road. But you don't want to get lucky today, and winning big early on can actually be a negative thing for long-term success. So some benefits of trading small. Again, I'm a huge fan of having small position size, not just practically from a percentage of your account size, but also from an emotional point of view. I've spoken about this at length many times. Go back to the episode, watch your number. This is essentially a variation of what we're talking about today. What is your number? What's your number that you're comfortable with? Not just for losing on one, having a monetary loss on one trade. But what if you have a string of losses on several trades? Because you're going to have strings of wins, you're going to have strings of losses, and it's the average of the long term which is what we're looking at more than anything. So the only way to combat that, so that you're in business today, tomorrow, next week, next month, next year, and not worry about what happened yesterday, is to trade small. So risk mitigation is what we're talking about. It limits the potential losses, especially for new traders, because you're navigating the learning curve as well. Everything is brand new to you. It's new charts, new skills, new computers. Maybe you're into programming. There's such a vast amount of knowledge out there. Not all of it is great, let's face it. So, wading through the learning curve as well, while you're or having small risk while you're learning is also crucial. And along a similar vein, hit a demo account. Practice on paper first, in a safe environment. I mean, just because we're trading the financial markets, for whatever reason, people think that it's okay to go live straight away. I mean, if you look at any other career choice or pastime for that matter, there's a lot of practice environments. Cricketers are in the nets, baseball in the nets, basketball, you're on the practice courts. You see where we're going with this. There's a lot of pre-game practice goes into it, and having small risk, if you do trade a live account, is going to help you with that practice game so that you've got your licks in. And again, trade the demo accounts, trade it on paper, trade the virtual accounts. Don't underestimate the power of just pushing the buttons, because maybe the brokerage account is brand new to you, so you can go and push the buttons and without fear of pushing the wrong button. So mitigate that risk in a variety of different ways. And if you must trade a live account, trade small. Also think about the learning opportunities, as we just touched on. Look at real market experiences with that lower stake at hand. If you are worried about the markets, like right now, I've been talking about for what seems like far too long, a corrective move in the markets. A corrective move is 10% at 10 days, no more than 20%. Anything more than 20% would be a crash, as I've defined it, as most people define it. We're in the season for corrections. There is a season to these things. Once, maybe twice a year at most, but typically once a year on average is a corrective move. So look back over the times where these major movements happen, 10% in 10 days. There is a season for these things. And there's a learning opportunity that comes with them. And if you are trading through such times, if it's the first time you're experiencing these things, you see a major market movement unfold for you or in front of you, or you're a part of that move, maybe on the right side, maybe on the wrong side. But having that lower position size, it's going to help you enhance that learning because you've got something real and tangible in the markets while you're learning. You can start to interpret and understand what is happening in the markets and also ride the weather of emotions, because you do have an immense amount of emotions in the markets, especially early on. And this is one that I learned the hard way, for that matter. I was very self-aware quite early on in my trading career. I knew that emotions were going to be something that was going to be the secret to long-term success, or one of the several facets to success. But you're able to start to monitor and track your emotional state of mind before, during, and after trades. And again, if you've got that lower position size, it allows you to be self-aware, it reduces the stress and the emotional pressure and allows for better decision making. And again, if you have a string of losses, we want to be able to put the next trade on always, because I don't know when the winning streak is going to start any more than the next person. I just know that on average it's expected, because I've got a positive expectancy strategy. I know that 7 out of 10 trades on my latest strategy win. I don't know which 7 out of 10 trades work. Maybe there's a string of losses, maybe there's a string of wins. You can have 20 back-to-back wins. Equally, you could have 20 back-to-back losses, just like you might toss a coin, heads or tails, win or lose. And you can have in the short term, you have 10 back-to-back wins, 10 back-to-back losses, 10 back-to-back heads, 10 back-to-back tails. But when you start getting into the thousands of trades like I have and many of my students have, is it all starts to average out and you start getting close to that 50-50. So what I want is to get close to my strategy. That's 65, 70% of the time I'm winning, and 30-35% of the time I'm losing. But I don't know which trade, so I've got to take every trade, which is why I have a rule-based system. It's why I trade small position size, so that I can weather any stock market storm that may come my way from the strategy point of view, and also market conditions. As we saw in 2020, shit can hit the fan very fucking quickly. Excuse my French. But if you're unprepared for market crashes and corrections, you might wonder what on earth is going on. I mean, I know that they happen statistically. Crashes happen once every 10 years. Corrections happen once every year or every other year. And there's a season for them, as it started to before I took a detour down this little side alley. It's February, March, and September, October. They're the 2 seasons for corrective moves. And then the same season turns into a crash once every 10 years on average. It's an average. Again, last year we skipped the corrective move, so I am expecting it. This year, a corrective move. Last time such a thing happened was 2017, 2018. We skipped 2017, and we had 2 huge corrective movements in the following year, 2018. So go back and study these market conditions. It is going to be of benefit to you. And again, if you're trading through them and you've not done this, you've not got the market experience, you will have the benefit of a lower emotional reaction when these crazy things happen, so that you can make those informed decisions relative to the trading strategy that you have. So some more points on this. Again, you want to build up slowly. Again, some of it is underestimated or completely never talked about. I seem to be mentioning it a lot every other week at the moment in one form or another, and that is your emotional bank balance. Your trading balance, again, talked about, many books written about it, many careers on the back of it for a lot of psychologists. But the reality is that there's very little is written or spoken about your emotional bank balance. Do you have the emotional capability to trade the risk and position size that you have? You might be a multi-gajillionaire for all I know, but when it comes to trading, you're starting off at the bottom of the rung. So yeah, you've probably got a larger tolerance than the next person, just because your net worth is huge. But when it comes to trading, you're starting at the bottom rung, so your emotional bank balance is lower compared to what you've been used to. And I've seen grown-ass multimillionaires cry over another $50 loss, because it was another. It's not the money; it's just the stress and reaction, because their emotional bank balance is on a level playing field with everyone who starts out brand new in trading. And sure that they might have transferable skills both practically and emotionally to bring to the trading game because they've seen success in other areas of their life. It's not automatically and fully transferred over when it comes to the realm of trading. So don't underestimate this emotional bank balance thing that I've mentioned many, many times now. We all start off with a low emotional bank balance. So I always think about what's your number, when it comes to per trade risk. The position size that you have, if you had, say, for example, 10 losses back to back, can you handle 10 losses? And if the answer is no, then your position size is too big. And to be fair, look at how you react when you have a real trade on the line and it happens to be a monetary loss. Notice that I'm not saying a loss, a losing trade. A winning trade is a trade for me that I followed, so according to my trading plan, whether it produces a monetary gain or a monetary loss. So just producing a monetary loss isn't an automatic losing trade. So there's a little bit of reframing for you there as well. So a monetary loss, sorry, I completely lost my train of thought there, but a monetary loss, is not a losing trade. And what you're able to do is evaluate the situation with a lot more ease and grace than you would have with larger position size. And again, I've seen, many very wealthy people cry over a $50 loss because their emotional bank balance wasn't there to handle that particular trade or a string of trades that they were on the back of. So reduce your position size is really what I'm getting down to. If you have a monetary loss, so that's what I was about to say before I deviated, completely lost my train of thoughts. If you have a monetary loss and your emotional reaction is adverse or not something that you desire, then your position size is probably too big. Jesse Livermore wrote in the book, Reminiscence of a Stock Operator, reduce your position size down to the sleeping level. And it's some of the best advice, and it's a throwaway line in a book that was written over 100 years ago. And it's so true even to this day. So reduce your position size down to sensible levels. Now, understand the market dynamics as well. That's what you're able to do. You're able to assess and evaluate market conditions without the pressure of having huge sums of money at risk, because it's very easy to be like a rabbit in the headlights when you have large sums of money relative to your situation in the markets. Also, you have the opportunity to test and refine ideas. I'm at the stage now where if I have an idea, I very quickly, after an initial research phase, will start to put real money on the line. Again, I'm just fortunate. Again, I've got a career of doing this. I'm not paper trading and watching in real time. I'm very quick to put real money on the line, but I can do that with small position size, so that even today, I'm not having interference. I'm not stressing. I'm not worrying. I'm not kicking myself. I'm trying to evaluate in real market conditions with real money how this trade performs. And you'd only start to understand the nuances of a trade when you have real money at risk. So again, have small risk, even with new strategies, for experienced traders, so that you can make those evaluations and see how the strategy unfolds compared to what you expected or how you expected. And again, if you're brand new, simulated trading, again, this is non-conventional, but we used to call this paper trading because you used to write it down on paper. You never used to actually put the trade on, but there's so many demo accounts these days where you can literally simulate the trade in real-time environments. You've got no benefit of hindsight. Simulated accounts or demo accounts, they just didn't exist when I first started out. You physically had to paper trade. If you don't have access to a demo account, just write it down on paper. Just note that the prices that you were looking at, take a screenshot of what you were looking at, and write it down on paper before you invest real money. Practice with that virtual trading account. Again, starting small, as I've already touched on, it allows you to keep focus of your emotional state of mind. Again, keep a diary, keep a journal, write these things down, what's your state of mind before, during, and after the trade, so that you can keep track of these things. One of the things that I was able to discover when I wrote such things down was that I got quite excited, overconfident, for want of a better description, with certain trades. And what I didn't notice until I went through the data after about 3 months, I was able to note that when I was overconfident, they were producing losses, monetary losses, quite consistently. So it was an indication to say, when I had this emotional response, rather than see that as a positive. For me, that was a negative, and it would never have occurred to me whatsoever if I hadn't been tracking such things. So be mindful in your trading and monitor your state of mind, and maybe it's going to give you clues. And interestingly, the opposites was also true. When I was most nervous, when I was almost, sweaty palms, rubbing hands, nervous, anxious, all those things that we associate with negativity, they were actually the best trades. So I was able to kind of, again, reframe my trading experience compared to my emotional experience. And also, lastly on this subject is scale small, incrementally. Again, rather than evaluate position size on every trade. For example, let's just say you are actually trading 2% of your account size on each individual trade. I'm not working that out on every individual trade that I place. I typically do it at the end of the month. What's my account balance? How do I want to manage my risk allocation for individual trades and also my account exposure? And then I have my per trade risk, and obviously I'm comparing that with what my number is as well, and if one is bigger than the other, I can make the adjustments. So practice what I'm preaching is what I'm getting at. But then if there's a situation where I've grown my account to such a point where I can increase position size, I'm not automatically doing it. I'm doing it at a point where I can handle the increased position size, both practically and emotionally. And if I were to hit a drawdown phase, I don't have to decrease my position size. So I've got a little bit of a buffer built in. So I usually make those evaluations at the end of the month so that I'm not faffing around with, I've got to increase position size and decrease. And I know that there's more efficient ways of doing it if I was to evaluate it every day or every trade like some people do and advocate. I just want to press the easy button. I just want to go, yeah, it's this dollar risk on every trade that I'm placing with this strategy, and I'll evaluate it at the end of the month. And it just takes that pressure off as well. So ultimately, I'm compounding the profits and not the losses, and I'm making sure that I've got a buffer that when I increase position size, I'm taking a positive step forward, and that I don't have to take a quick step back if I was to run into a string of losses. So ultimately, starting small is a strategic approach. It goes beyond just the financial risk management. It's about learning the intricacies of the markets yourself, mindset, your emotion. There's a lot of self-discipline involved, and basically gradually building confidence as you would in any career choice. You get more confidence, you get more experience, and you get promoted in a real job, real environments. Again, trading's no different. When you've got knowledge, experience, confidence, the mindset, you can start to exponentially increase your position size when it's relevant to do so. Now, this method ensures that traders like you and me not only preserve their capital, but also gain the experience along the way, can learn from that experience and put a foundation in place for long-term success in what can be sometimes a crazy-ass world of trading. So if you like what you heard today, be sure to follow and listen to the very first episode where I map out the first of several of my most profitable money-making strategies. If you'd like to learn more about my training and mentorships, head over to antivestor.com, or you can shoot me an email to phil@antivestor.com. So let's start that conversation and see if what I do is right for you. I've always got time for serious traders, and what I do isn't right for everyone. And if it isn't, I'll always point you off in the right direction. So that's all for today. Thank you for giving me your time and your attention and making me a part of your regular routine. Have a wonderful day, and I'll speak to you at the same time next time. Toodaloo, trader. Keep in mind that futures, options on futures, stocks and stock option trading involve a degree of risk that may not be suitable for all investors. There is a risk of loss in every investment that you make, and it's your responsibility to assess the risks of your decisions. Past performance is no guarantee of future performance, and Antivestor provides educational information and does not provide financial advice.